everybody, and good afternoon, and welcome to this panel session on India. You've just heard a pretty upbeat assessment from one of India's legendary bankers, Mr. K.V. Kamath. And now we're going to address the very interesting question of India's path to a $7 trillion economy by 2030. And we have a very distinguished panel, a very diverse panel from both the public and private sectors to do this. So we have 40 minutes, so I think I'm going to jump right in. Okay, very good. Now, Anantha, the first question is for you. Anantha, as you probably know, is India's chief economic advisor to the Ministry of Finance. So if anybody knows everything about the Indian economy, it's him. Okay, Anantha, now, a $7 trillion economy by 2030 would need an annual growth rate of double digits between now and then. Is this even conceivable, to be honest? And if so, what policies need to be put in place to enable it to happen?
Right.
And if not, what are the risks that would prevent it from happening?
Yeah, thank you, Vikram. I think since this is about numbers, you have to bear with me for giving you. So we are at $3.6 trillion. So 7 basically means roughly doubling. And since we have about 6 years to FY30, we're talking about 12% annual compounded growth rate in dollar terms. If you look at the 30-year data since liberalization, the Indian GDP has grown in dollar terms at around 9.5%. So, and if you look at the IMF view, is the next 5-6 years, the Indian GDP in dollar terms can grow at 10.5%, which means the fund is only expecting a mild rupee depreciation against the US dollar in the coming years, because in rupee terms around 11%, in dollar terms around 10.5% per annum over the next 5-6 years. That takes us very close to $7 trillion. What will drive this? I think private sector capital formation will drive this, because we have very strong balance sheets in the corporate sector and the banking sector. And of course, government will continue to be an important player in capital expenditure, but the private sector capex should drive both investment and employment and household consumption spending. I'm not counting on export growth. Whatever comes via exports will be a bonus. So that is not in my calculation, in my calculus. What can go wrong with this? Of course, geopolitics, trade protectionism, and also dislocation in financial markets, which can spill over into emerging economies. And Indian retail investors are very much in the market these days, and therefore any dislocation or significant correction in the markets can have implications for household wealth and household spending. That would be the risk factors.
But what policies would you need to put in place to enable this to happen?
I think much of the hard work in terms of enabling private sector capital formation has been put in place, including creating the physical infrastructure and creating reasonable tax rates, and also the ease of doing business. What more needs to happen is in terms of deregulation, so that the medium and small enterprises can actually participate, because without their visible presence and a substantial presence, we will not be able to scale those heights. So we need deregulation at the state and the local government level to facilitate MSMEs becoming part of the Indian manufacturing story. That will be the required reform for us to ensure that we get to this $7 trillion destination, which is also only a milestone, not a destination.
Right. Thank you, Anand. Zarin, I think you wanted to address the issue of what will drive India's growth towards a $7 trillion economy. And Zarin, as you may have heard, is the CEO of Standard Chartered Bank in India. So she's very well positioned to tell us about what can drive growth forward. Zarin.
Yeah. So just to carry forward from where Anantha mentioned, we will add one India, actually, between now and 2030. That's the size or scale of what will happen. And that's quite huge when you think of a 3.6 trillion economy getting adding one more India. By 2030, what we'll see is that the consumption demand in 2030 will be equal to today's India's GDP. So that's the scale of the opportunity that we are going to witness. And also what happens is when the per capita income crosses a particular point, it's expected that the per capita will be about $4,000. That's the inflection point that happens, which really becomes a consumption-driven economy. The other things that are very favorable for India is corporate leverage has come down quite substantially. If we look at the top 1,000 listed companies, the debt equity is 0.4:1. So we're seeing sizable corporate cash flow generation, and we are seeing huge amount of private sector capex now coming into play. Earlier, everybody was, I guess, waiting for election outcome, but now we are actually seeing every single corporate, big and small, doing private sector capex. The government is obviously front-ending the infra spend with doing about $120 billion annually in infra spend, which is also sort of giving the benefit of lower logistics cost because India's logistics cost is higher. What we are seeing in terms of the industries, actually, we are seeing EVs, batteries, solar modules. That capex in the sort of green kind of related economy is going to grow 8x because that's the scale of what we need as a country to go more green. And in the traditional sectors, which is like steel, cement, etc., we're seeing 1.3x of what was spent in the last 4-5 years. So when I say 8x, what was spent 4-5 years back, cumulative, we'll see that 8x in the next 6 years. The other thing, obviously, which is driving India's growth, and we've seen that in the export numbers, is the global capability centers. So India, every global company outside their home company, 1 out of every 2 has a global capability center in India. Our own bank, we have 30,000 employees working in our global capability center. So the services engine has been really doing well. We've seen services exports growing like 15% last few years. And that momentum will continue. And manufacturing with the lower logistics cost will also start playing a significant role. We're already seeing electronics as a sector really pick up in India. For example, Apple, we've seen how Apple has stepped up. And we're seeing a lot of investments in the entire back end of the electronics sector also. So these are few things that will spur the growth of the economy.
Well, thank you, Zarin, for sharing that, putting all the color on the growth story. If I turn to Vijay Shekhar Sharma, Vijay, you're one of the pioneers of the payments infrastructure in India. You're the founder of Paytm, as many of you know, is one of India's big private sector payments operators. So the question for you is, how has the digital payments industry changed the lives of people, and how has it changed the economy in India?
Yeah, thank you. Thank you for having me here. There's no doubt about it that the small merchants or the small businesses in India traditionally were trading or doing the business predominantly using cash, primarily and probably only cash. And that had the problem of that no state or regulatory support could be extended towards them because their identification compliances were not up to a level that we could have identified and be trusted. DBT, etc. benefits were able to be created for masses of consumers. But when you talk about trader or a shopkeeper, there was no way to identify. And digital payment, mobile payment gave the way of identifying sort of a heartbeat of this small merchant on a financial map. You now know that there is a shop here, there is a person here who's doing some bit of small micro business there. And that, in my opinion, is the biggest. Once you have an identifier, you can extend what you want to extend to them. So as expected, first of all, the small businesses, small businesses, and very, very small micro businesses were able to get support from even government. I'd say that Swanidhi credit loan program and many other state incentives, etc., that schemes that show up, they are able to show up. And as for consumers, we all became far more loving India country that when we go travel elsewhere, we're like, oh my God, this thing doesn't work here. Because now, as you heard, Mr. Kamath also talking about, and as we are very proud of what we see in India as a mobile payment, it's absolutely fantastic, world class. And I'm very proud to say, as consumers, now as citizen of India, we believe that we are forward looking and a great nation that is something absolutely world class at mass level. And payment is the everyday interaction of that. Right. So it gives confidence and trust in the state also.
Right, right. But your first point is basically it makes people bankable, or companies bankable that were not bankable before.
Yeah.
The cash economy, they were not bankable, but now you have the data because of the digital payments.
Yes.
And they can get loans and so on. And is that really happening? Are these small guys really becoming more included in the system?
Yes, absolutely. And I think government has and regulator has priority sector credit identifier by Aadhaar Udyam, meaning the business identification ID, which is exactly what these small businesses used to be going through exorbitant credit at an annual interest rate. They would sound so exorbitant that it is not even logical to talk those numbers. But now, today, a formal financial institution, PSU or a private sector bank or an NBFC or many other players are able to extend their small credit to large credit, all because that you have everyday collections. In fact, as Paytm, we've been able to successfully see tens of billions of dollars of disbursements in a year, only because that we were able to even collect back everyday collections. So the very mode and the method of disbursing through the RERA and everyday collection of the receivable makes this a very viable way of small businesses getting credit. In my opinion, this is a revolution after the payment, in my opinion, that India will give to the world, that how do you support these micro and small enterprises or businesses that you are able to extend the credit and even collect that in a very efficient way. Because the cost of collection and losses have been previously the reason that we were never able to extend a small credit. If you want to extend, let's say, 50,000 rupees or 1 lakh rupee, the cost of collection was so high that you never thought that you would ever do it. Now, the fact that we are able to make small payments as a mobile payment and small credit collection as a mobile collection, voila, we have a recipe here.
Okay, that's good to know. Well, now Mr. Rajaraman is the boss of Gift City. Gift City is India's first international financial center, as far as I know. Yeah. But Mr. Rajaraman, it's a bit of a mystery to many people. I think people know that it's a tax haven which tries to onshore a lot of what is previously offshored. But how does it serve the Indian economy? And is its impact significant so far?
Yeah, thank you. Let me take one step back and then say that now the narrative is about how people can invest into India most significantly in a better way, in different ways, etc. So if you look at the investor confidence in India, last year, for instance, I think nearly about $70 billion worth of foreign direct investment flowed into India. So today, if you want to invest into India, I think there are several options. You can sit in Singapore and directly invest into an enterprise in India or into the markets. You can also set up operations in India, say in Mumbai or Bengaluru, and then invest into India. We have created a third option, I think, called the International Financial Services Center, which is actually a hybrid of both. Sitting in Singapore, I think you enjoy the benefits of a global ecosystem where you have freedom, flexibility, etc. Whereas if you are in India, you're in India's time zone, you enjoy the low cost of operations, including the low human resources cost or the low cost of real estate and so on and so forth. So we have created this platform which actually gets the best of both. So this International Financial Service Center located in the city of Gandhinagar in Gift City is actually a deemed foreign territory within India. Okay. So which means that the Foreign Exchange Management Act of India does not apply. Okay. So you can move in capital or move out capital, you can repatriate profits without any controls. There are no capital controls. So the currencies that are permitted are only the foreign currencies, including the Singapore dollar. So therefore, and business setup there in the financial sector enjoys a kind of freedom which probably they would not have in India. So at the same time, you would enjoy the benefits of being within India by sharing the same manpower, accessing the low-cost, I think real estate and human resources and other benefits or the scale that India enjoys by sitting within GIFT City. But when you are doing that, let's say, I think in the last several years, since 2019, when the Parliament enacted the International Financial Services Center Authority Act, which actually bestowed the powers of the domestic sector regulators on us. So we are all the domestic regulators put into one. We are unified regulator for the banking sector, insurance, pensions, stock markets, etc. So what we have done is that we have gone by a clean slate approach. We didn't copy or cut and paste domestic regulations. What we did was that we looked at what Singapore does, Hong Kong does, Dubai does, and then kind of drafted what should be in terms of a globally benchmark jurisdiction. So our regulations are simple, they are not prescriptive, they are principle-based, and more aligned to international regulations. So when an investor, say, wants to launch a fund in GIFT City, he wouldn't find the regulations very different from what obtains in, say, in Hong Kong or Singapore for that matter. I think that kind of flexibility is there. So the proof of the pudding is in the eating, finally, I think. So after the last 5 years of effort, when we wrote all the new regulations, today we have 28 international banks there. Their asset size is about $71 billion. They provide trade and credit project finance to Indian corporates. So today an Indian corporate does not need to go to Luxembourg or to Hong Kong to raise finance. For instance, last fortnight, one of our largest Indian state-owned enterprises called Power Finance Corporation, it does a lot of lending in the renewable energy sector. Right. They raised a $1.2 billion trade finance in GIFT City. So a consortium of banks within GIFT City help them to do that. So you don't need to go out anywhere, I think. You have a piece of international financial center sitting inside India. So that's the point. Similarly, if you take the fund industry, today we have nearly about 180 funds registered in GIFT City, which are focused on investing into India. There are funds which are also raising capital from Indian residents and investing into global markets. So it's both inbound and outbound. So to summarize, I would like to say that it provides a global financial services solution for the Indian corporate. So an Indian corporate, if he wants to do business, he wants domestic capital. He also wants to raise foreign capital for certain purposes. So that foreign capital and foreign financial services can be raised out of GIFT City effortlessly today, I think, thanks to the architecture that we have put in place. Yeah. So we look, if I may give one more example, I think we have about 14 million non-resident Indians who live across the world. There are about 18 million persons of Indian origin who live across the world. We have also now built a set of products for them to invest into India. Like, for instance, there are dollar insurance products, there are dollar savings products, structured finance products. Then we have capital market products, including derivatives or portfolio management services. So all this can be obtained within GIFT City effortlessly, I think. So, for example, an NRI wants to invest into India in rupee terms. He also wants to keep a part of his portfolio in dollar terms. So that can be afforded in GIFT City. So we are like a solution provider for global financial services for the Indian corporates and also for people they are non-resident Indians who live across the world, I think. Right.
Thank you. That's interesting. It's in India and yet not in India in some ways. Huh? Now, I don't mean to take this conversation in a slightly negative direction, but I have to ask this, Anantha. I mean, unemployment is a major problem in India. And the numbers are debated and so on, but I think nobody disagrees that it is an issue. It was an issue in the recent elections. It is a big issue as put out by reports by the ILO and so on. So the question is, why has India's high growth not led to mass job creation? Right? And it's also created a lot of inequality. The World Inequality Report puts India at one of the most unequal nations in the world. Now, there is a high degree of financial inclusion, but there doesn't seem to be a huge degree of economic inclusion. Why has this happened, and what is being done to address this?
Vikram, you began by saying nobody disagrees, but I would like to disagree.
Okay.
Because I don't think there is a problem of job creation. What we are interested is in the quality of jobs that are being created. Jobs are being created. It is the quality of jobs that is more important and where we want to focus on. Because if you look at the numbers in terms of either unemployment rate or the registrations in the employee provident fund organizations or the private sector indicators like Naukri.com, job indices, etc., there is enough evidence out there that shows that job creation is happening. But what we are also more concerned about or watching is what is the quality of jobs that is being created. So I would say that is a bigger, more important issue than the very act of job creation itself. And people say unemployment is lower because we are counting agricultural employment. That's partially true and statistically true. But however, the jobs that are being created in the rural, in rural India are also now people working on their own account, not in unpaid jobs, but generating their own incomes, etc., and participating in family enterprises. I wouldn't consider that as disguised unemployment. Then the second point you made about inequality, but again, I think financial inclusion has led to better equality in the sense that if you look at the Gini coefficient done by the Price 360's consumer survey, post-COVID, actually, the Gini coefficient in the last 2 years has compressed rather than widened. And also, as Vijay was pointing out, if you look at the financial wealth that has been created in the last 4 years and its democratization, because stock ownership in India, with people earning less than 200,000 rupees income per month, they own 43% of the equities that are held by households in India. In fact, the equity ownership in India is much more democratized than even in advanced economies. What we need to do, and therefore I partially agree with you, that it is not enough to say that we are creating jobs, but we have to keep creating this for the next 30 years at the rate of 8 to 9 million jobs per year. And that is why the budget that came out in July gave enough incentives to the industrial sector for generating jobs, providing them subsidies for hiring in terms of defraying their employment provident fund contribution costs, etc. And we need to make sure that the graduates we churn out of our universities are employable, and that is the reason why the focus is on skilling and employment and internship in corporate sector, both forward and backward integration. So I think policy-wise, there is no gainsaying the fact that employment generation is a priority. But what we need to be mindful of, and that is applicable to the whole country, whole world, except that in the case of India, the numbers are much bigger, it is what is it that we are going to do about artificial intelligence and its impact on employment. And that is a more pressing issue for India given the numbers. So, and that is where the private sector has to strike a balance between short-term bottom line and medium-term creating the household income that will in turn actually revert back into their own top line. So that is the area where we don't necessarily have answers globally at the policy level, because this is something that the private sector, governments, and the households have to sit together and figure out what is the right balance between technology and labor, and what is the right balance between capital and labor shares of income. It is a global issue and not unique to India.
I just one basic quick follow-up. I want to get to artificial intelligence and its impact later. But the quick follow-up on job creation. I mean, you mentioned the need for the quality of jobs, but some people say we need also quantity of jobs. And so one observation that many economists have made is India has not prioritized labor-intensive industries. A lot of the PLIs, the production-linked incentives that the government to incentivize manufacturing, are in capital-intensive areas, are labor-saving areas. And India has been overtaken by countries like Bangladesh in garments, Vietnam, in other labor-intensive industries. Now, should India be prioritizing or incentivizing more labor-intensive industries to create jobs?
So the prioritization of labor-intensive industries and job creation is precisely the reason why this budget came out with specific schemes for job creation in the manufacturing sectors. Whether it should be done through the PLI route or through these kinds of general incentives for all manufacturing sectors is a separate discussion, but we have prioritized labor-intensive manufacturing by specifically providing incentives and subsidies for jobs created in the manufacturing sector. But your point is well taken. And the way to do it is through, as I said in my earlier response to your question, through deregulation. In the sense that if we have to create employment on the scale that even Bangladesh and Vietnam are able to create, our rules and regulations must be exempt for organizations, let's say not up to 100 or 300 or 500 employees, but up to 5,000 employees. Because we sometimes deregulate in small increments. So that vision has to happen, but the bulk of that deregulation agenda, fortunately or unfortunately, is in the realm of states, not in the realm of the union government. And that is where the action is. So, to incentivizing labor-intensive manufacturing can happen through ensuring that the burden of regulations does not disproportionately fall on small and medium enterprises. If we remove that yoke, then automatically job creation in labor-intensive sectors will happen.
Okay. Yeah. Now, Zarin, we are at the FinTech Festival, so I can't let you go without asking you this as a banker. How has banking in India been impacted by FinTech? In what areas do you collaborate and where do you compete?
So I think we collaborate and compete, and I'll talk of StanChart, not India alone, but StanChart in other countries also. So StanChart has something called a FinTech bridge, and we've successfully engaged with about 3,500 fintechs. And this fintech bridge is a platform to fintechs to apply for any open challenges that StanChart is trying to solve. So it's a use case, and fintechs pitch their solutions to the bank. And we have also invested in fintech companies, about 30 of them. We've incubated our own ventures also in digital assets. For example, Zodia Custody, which we are doing, is a DLT for digital assets, and we provide custody services to our clients. We also have a chain analysis platform to facilitate online anti-money laundering monitoring, etc. We've also invested in a company called Partier, which is a distributed application network. And actually, Partier is a rail. It does not create products, but it facilitates movement of DLT products, like tokenized deposits and CBDC on the chain. So there are multiple such initiatives that StanChart has done. And another thing that we've done is API banking. So for our corporate customers, StanChart India is 70% of StanChart global volumes in API banking, because India has gone really digital. And we have about 2 billion API calls annually. So that's the volume of API transactions that we are handling. So the other thing that we've done is something what we call payment as a service for our customers. It's again an API-based programmatic payout where we do payment as a service, and in India we've launched it for our corporate customers. And in China, for example, has a concept of digital electronic debt certificates. So if there's a big corporate and they have a vendor, then the vendor is able to use the receivable and discount it and get some money upfront. And if that vendor has a sub-vendor, that sub-vendor can use the original supply, the original corporate credit. So this kind of tokenization is also something that is done. We've also worked with a fintech called Linklogis in China. So there are multiple things that StanChart has done globally with the fintechs, and being a fintech ourselves.
Okay, right, yeah. Very good. Now, Vijay, speaking of fintech, you've created a big payments infrastructure, the biggest private payments infrastructure. What is your next act? Are you able to build on the payments infrastructure that the government has put in place, such as UPI? Are you able to do that? And honestly, do you think the government's payments infrastructure is crowding out private players?
I'll answer the second one first. I think the government support to the payment industry is the biggest catalyst for the spread of the payment industry or the scale of payment industry that we see. The fact that government subventions and offers zero price MDR for UPI payments is one of the lowest entry point decision making for a small business to make a payment decision taking. So many a time this discussion comes forward that how long government keeps supporting, and I keep saying till the time period pendulum is perfectly towards the other side that it can't come back.
Okay.
And so I'm all and obligatedly going to say that in different part of the world I go and see that mobile payments have shown up, but the penetrations haven't shown up because people have tried to harvest the money out of it in a payment system, which as a private player I would love to, but I really want to tell you that our government's support means the critical success reason here. And as far as the government support, I think you're alluding towards the payment system which is concentrated towards sort of, it's not a government body, it's a private body, by the way. Shareholders are many. UPI system is operated not by government, but a private body. And many of us are shareholders, incidentally. And I would say fabulous work out there. And different innovations get expanded and extended, I'd rather say that, not blocked at a scale that we see. The next question, I talked about access to capital. A small business sort of have this payment account where the daily receivables are coming. We've seen a success on giving small credit and then receivable every day. And I've seen that even the wealth solution we just talked about how India's small household incomes are now constituting upwards of 40% of stock market investments, is what is that we are also seeing. So typically, as you know, in India, the small shopkeeper gives everyday money to somebody to, it used to be called chit earlier, and we are trying to standardize it by virtue of creating a SIP, daily SIP. Okay. So we've created a 21 rupee, 51 rupee, 250, up to 250 rupees different unit denominations for daily SIP. So if you as a small shopkeeper are receiving everyday payments.
Sorry, what is SIP, just to be?
A systematic investment plan where you issue deposits every regular frequency, okay, and it becomes your wealth account. Yeah. Lump sum versus SIP. SIP is a regular interval investment, lump sum is one time. So we've seen, and we are very happy to see the initial play where the merchant who typically does not know what is called wealth, in other words, they are always short of money and they are always short of savings, they are able to invest in SIP. And as the fabulous India's mutual fund industry, or rather I would say equity industry, is showing up, the wealth of small shopkeeper is able to be back to the economic wealth of the country, namely stock exchange. Here, every day $250 or 500 rupees or 100 rupees investments are creating next revolution of payment extending to credit, extending to wealth. Okay. So for me, the next act is how we sort of democratize, scale the payment distribution. Can we extend and expand credit distribution and wealth distribution to the same people?
Okay, thank you. Right, great. Now, Mr. Rajaraman, you talked about what Gift City has been doing so far. What is the roadmap for the future? And what constraints do you face? For example, to be honest, is location a problem?
Okay, thank you. So as you just mentioned in the beginning, initially we started off with the thesis of being a destination to onshore Indian businesses which were offshore, but like funds or leasing businesses, etc., which were done outside India, but completely India-focused. And that's been achieved to a large measure by many of these funds, aircraft lessors, ship lessors, relocated back to Gift City. Now our agenda and focus is now shifted to the government's vision of Viksit Bharat at 2047, which is the Honorable Prime Minister of India has actually expressed this thought, and the government of India is working on the process of on how to make India a developed country by 2047. So this, if you were to break it up into many, I think some of my co-speakers also mentioned that it will require humongous investments in the infrastructure sector, maybe something like $300 billion every year going forward for the next 20 years. If you look at the net zero agenda at 2070, so many countries want to do it by 2050, India wants to do it by 2070. That will require about $10 to $12 trillion for India. I mean, again, looking at manufacturing, like semiconductor businesses, a lot of work is going on, a fab is being set up, etc. That will also require at least about $3 to $4 trillion in the next 20 to 25 years. So there will be huge demands of capital for this growth vision. So which means that a lot of the capital will get raised within India. As Anant just mentioned, the bottom of the pyramid is now actually catching up and actually moving into the middle class. Currently, the middle class is about 35%. By 2047, about 65% of the Indian population will be middle class. So which means that the ability to save, invest, pension, and insure themselves would be huge. And they will play a very important role in raising capital and generating capital within India. But still, I think we will require a lot of foreign capital to come. So the idea is that GIFT City will remain a platform for foreign investors to come into India on a soft landing basis. And we expect to play, while we do all those things like, corporate credit, the equity, private equity, and all that stuff, we also want to become a sustainable and a climate finance hub, because that's a very important area where I think raising capital is going to be a big challenge, especially for transition financing. So at this point of time, we have a green credit framework where banks are being nudged towards lending for green. About $1.5 billion has been lent within the last 1 year. We have a green bond framework, wherein nearly about out of the $65 billion of bonds listed on GIFT City exchanges, about $14 billion are green, social, sustainable linked bonds. So we want to do more of that. I think this is just the beginning. So we will need to do probably 20x, 50x of this to actually deliver capital for India's 2047 agenda, and we intend to do that. So if I come back to the last question on your challenges, and obviously ease of doing business is work in progress. So while Government of India continues to reform, I think nearly about 1,550 laws of colonial era have been scrapped. New laws are being written. Like, for instance, I used to be the permanent secretary in the Department of Telecom till last year. We were governed by the 1885 Indian Telegraph Act written by the British. So I had the duty of replacing it with the Indian Telecom Act of 2023. So every ministry is on the job, and over the next 3 to 4 years, you will see a lot of new modern laws being written, which will actually be business friendly and actually more oriented towards ease of doing business, lowering the cost of doing business, etc. So IFSC will play a very important role by continuing to reform and also ensuring that we have our ease of doing business benchmark to the rest of the world, I think. So the challenge will be the ease of doing business. And that is work in progress, and we will be on the job, I think.
What about location? Is it a problem?
Location, see, let me put it this way. See, today, a lot of business is actually done virtually, I think. Today, if you look at some of our tech sectors, people don't work. I think people work at home. People work from other continents, etc. So today, location is no issue. I think the question is that how do we deliver value out of the current location? So therefore, like many of the tech companies, like for instance, the Bank of America. He's got one of his largest capability centers in GIFT City. 2,100 people work here. I'm sure that the CSET regulations also permit people to work from other jurisdictions as well. As far as we are concerned, we have kept the substance requirement light, so that I think people can also have back offices in Mumbai and Bangalore, etc., where they can actually do a lot of work for leading to investments. So therefore, in a sense, I think we ensure that there is a combination of both substance and also ease of doing business.
Okay.
Yeah.
I'm afraid we're actually out of time, but I did want to raise this one question about AI, which Anant, you had mentioned. And it's a very broad question. How well placed is India to leverage AI? And what will be its impact, both positive and negative?
I think, in fact, that question should be posed to my fellow panelists on my left, how well India is placed. But I think based on some of the studies done by international agencies, it does look like both from an education perspective and from the industry preparedness perspective, India looks well placed to take advantage of the AI, because many of the jobs that India is doing, excepting some in the low end of the IT-enabled services, they are more labor complementing rather than labor displacing. So I think compared to many other emerging economies, it appears that given the vast pool of skilled labor available in the country and the fact that the GCCs and the Indian software companies are in the cutting edge of developing these codes, etc., India appears better placed than many to take advantage of the AI. It has to be done in a manner that is socially sustainable and socially stable. And that is where the challenge lies more with the private sector than with the government.
Okay. Anybody would like to add?
I'll just, because I was asked by Sir, so I'll just say that. For the first time, Indians have started to, last 10 years, we can see, solve the problems of India by Indians by developing technologies in India. by not necessarily foundationally thinking the way necessary. I'm not going to say the West does it in a one way and we do it in a different way, but trying to say that homegrown solutions which are very fitting into the necessity of the ecology or the environment that we live in. And in that context, the AI offers us dramatic more opportunities to solve for next level of problem solutions, not just inclusions like we said. Hopefully some of us will go up to the economic inclusion, not just financial inclusion.
Okay. Well, fantastic, and I hope AI accelerates India's route to a $7 trillion economy.
Yes.
Well, we are long past time, so I'm afraid I have to call this to a close, but not before we thank our panelists for a very stimulating session. Thank you all, and thank you for listening.
Thank you.
Thank you.